Yesterday, the market reacted to a hot inflation print by selling chip stocks and rotating into defensives. Today, we got an even hotter inflation print, and the market did the opposite of what it did yesterday. The S&P 500 and the Nasdaq both hit fresh all-time highs. So before we get into what happened, here's the thing to remember about this market. It's not consistent. It's decisive. And what it decided today is worth understanding. Here are today's numbers. The S&P 500 gained 43 points, up 0.58%, closing at a record 744. The Nasdaq jumped 314 points, up 1.2%, closing at a record 26,402. The Dow lost 67 points, down 0.14%, finishing at 49,693. And the Russell 2000 closed essentially flat, up just 0.07%. So small caps and the Dow flat to lower. Tech, ripping. Here's what makes today remarkable. The April Producer Price Index, which measures wholesale inflation, rose 1.4% month over month. That's the biggest monthly increase since March 2022. Analysts expected 0.5%. The annual wholesale inflation rate jumped to 6%, the highest since December 2022. Core PPI rose 1% versus 0.4% expected. Every part of this print was hotter than estimates. Combined with yesterday's CPI, we now have two consecutive inflation prints that confirm the same pattern. Inflation is reaccelerating. The case for hawkish Fed positioning is mathematical at this point. So the warning signal flashed. And here's what flashed with it. The bond market noticed. The 10-year Treasury yield rose to 4.47%, the highest level of 2026 and the highest since July 2025. The 20-year and 30-year Treasury yields both crossed 5%, the highest since May of last year. Bond investors are pricing in higher rates for longer. They're saying the Fed cannot cut into this inflation. They might even need to hike. But stocks ignored the bond market completely. And not just by holding their ground. By hitting records. The records came from one place. Tech. Nvidia gained 2% ahead of next week's earnings. Micron added 4%. The semiconductor ETF rose 2%. Meanwhile, 2/3 of the S&P 500's individual stocks closed lower today. Communication services and financials fell. Utilities dropped over 1%, hit by rising yields. The Dow's biggest losers were Salesforce down nearly 3% and Home Depot down 2.5%. The biggest winners on the Dow were defensive names like Johnson & Johnson and 3M. So the picture today looks like this. Bond market priced in higher rates. 2/3 of stocks fell. But chip stocks ripped on AI optimism ahead of nvidia earnings, and that was enough to drag the cap-weighted indexes to records. This isn't a broad rally. It's a single stock cluster rally that's powerful enough to override every other signal in the market. Schwab pointed out something worth knowing today. The S&P 500 hitting records while less than 60% of its components trade above their 50-day and 200-day moving averages has only one historical precedent: December 1998 through March 2000. Veteran investors won't have to look up what happened next. Not a prediction, just a precedent. And precedents matter when you're watching the same setup play out. So, what do you watch from here? The first thing is nvidia. Earnings are next week, and the entire AI-driven rally is hanging on what that print looks like. The setup is bullish. Bank of America's price target is $320. Oppenheimer's is $265. Analysts expect $70 to $78 billion in revenue. The pressure on nvidia to deliver is now enormous. The second thing is whether the bond market keeps selling off. The 10-year above 4.5% starts to compete with stocks for capital. If yields keep climbing, valuation math gets harder. The third thing is the Cerebras IPO, which prices tomorrow and lists Thursday. It's the biggest 2026 IPO and another AI infrastructure pure play. How it opens tells us whether AI demand for new issuance is still red hot or finally cooling. Yesterday I said the warning signals just got real. Today they got louder, and the stock market ignored them anyway. Both of those things can be true at the same time. The signals are real, The market is choosing not to listen. The question is just how long it can keep choosing. We cover the days the markets actually move, typically a few times a week, more when things get wild. Hit subscribe so you don't miss it. We'll see you next time.